When central banks around the world began raising interest rates starting in 2022, few anticipated that the biggest losses would be borne not by those who invested in risky assets, but by those who invested billions of dollars in what seemed like the safest possible investments, United States government bonds and mortgage-backed securities guaranteed by the government. The paradox lies in the fact that these assets, which were always considered the gold standard of reliability, within mere months transformed into the source of the biggest banking crisis since 2008. By the end of 2022, American banks had accumulated over $620 billion in unrealized losses in their bond portfolios, and by the third quarter of 2023, this figure had risen to $684 billion. For comparison, this was almost equal to 1/3 of the total capital of the entire American banking system, which stood at approximately $2.1 trillion. The story of how this happened begins with fundamental laws of financial mathematics that operate regardless of whether market participants understand them. At the core of this crisis lies a fundamental property of bonds, the inverse relationship between their price and yield. When you buy a bond, you essentially lend money to the issuer, who commits to paying you fixed coupon payments and returning the nominal value upon maturity. Imagine that you purchased a 10-year bond with a nominal value of $100,000 and a coupon rate of 2%, when market interest rates also stood at 2%. You would receive $2,000 in coupon income annually. But now, suppose that a year later, the Federal Reserve raised its base rates to 4%, and new bonds are now being issued with a 4% coupon. Your bond with a 2% coupon suddenly becomes much less attractive. Why would anyone buy your bond paying only 2% when they could buy a new bond of the same quality paying 4%? The answer is, no one would buy it at the nominal price. To sell your bond, you would have to lower its price to the point where the effective yield for the buyer would equal the new market rate of 4%. The mathematics here is simple and merciless. When rates rise, prices of existing bonds fall. When rates fall, prices rise. This is not a matter of strategy or luck, it is the arithmetic of discounting future cash flows. To predict how much the price of a bond will change when interest rates fluctuate, financial professionals use the concept of duration or term to maturity. There are two main types of duration: Macaulay duration and modified duration. Macaulay duration shows the weighted average term until receipt of all cash flows from the bond, where the weight of each payment is determined by its present value. The formula looks like this: the sum of the products of each cash flow discounted to present value multiplied by the time until its receipt divided by the current bond price. But for practical application, modified duration is more useful, as it directly shows the percentage change in bond price when yield changes by 1 percentage point. The formula for modified duration is Macaulay duration divided by 1 plus the yield to maturity. For example, if a bond has a Macaulay duration of 8.8 to 2 years and a current yield of 2%, then the modified duration would be 8.8 to 2 divided by 1.0 to 2, which equals approximately 8.6 minus 5. This means that when rates rise by 1%, the price of this bond will fall approximately by 8.6 minus 5%. Let us consider a concrete example with real numbers. A 10-year bond with a nominal value of $1,000 and a 2% coupon issued at par when market rates stood at 2% will have an approximate Macaulay duration of around 9 years. Its modified duration will be approximately 8.8 to 2. Now suppose that the Federal Reserve raises rates, and the yield on new 10-year bonds rises from 2% to 4%, an increase of 2 percentage points or 200 basis points. The formula for calculating the price change is: the percentage change in price approximately equals minus the modified duration multiplied by the change in yield. In our case, minus 8.8 to 2 multiplied by 2%, which gives minus 17.6 to 4%. Therefore, our bond with a nominal value of $1,000 now costs $1,000 multiplied by 0.8 minus 236, which equals approximately $824. Using more precise calculations with the cash flow discounting formula, the price will be around $837. The difference is explained by an additional factor called convexity, but the basic estimate using duration provides a sufficiently accurate result for most practical purposes. Key takeaway: when interest rates double from 2% to 4%, a 10-year bond loses approximately 16 to 18% of its value. Now imagine that you are not a single investor with one bond, but a large bank with a bond portfolio of $100 billion. If the average duration of your portfolio is 7 years, and interest rates rise by 2 percentage points, your loss is calculated as follows. 100 billion multiplied by 7 multiplied by 2%, which equals $14 billion in losses. This is not a theoretical figure, this is real money that evaporates from the balance sheet. If your bank has capital of $15 billion and losses on bonds amount to $14 billion, you suddenly find yourself on the brink of insolvency. And exactly this happened with Silicon Valley Bank in March of 2023, becoming the second largest bank failure in United States history. Silicon Valley Bank was the favorite bank of technology startups in Silicon Valley. At the end of 2022, the bank had assets totaling approximately $209 billion and deposits of $175.5 billion. Of these deposits, an astonishing 94%, or $151.6 billion, were uninsured, meaning they exceeded the Federal Deposit Insurance Corporation insurance limit of $250,000 per account. The bank's securities portfolio totaled $117 billion, of which $91.3 billion consisted of bonds classified as held to maturity. These bonds were purchased primarily during 2020 and 2021, when interest rates were at historic lows. 10-year United States Treasury bonds yielded approximately 0.5 to 1%, and mortgage-backed securities guaranteed by the government yielded 1.5 to 2.5%. The bank was buying long-term bonds with maturities ranging from 5 to 30 years, essentially freezing these low rates for decades. Approximately 65% of bonds in the held-to-maturity category had maturities exceeding 5 years, many of them 10 or more years. When in March of 2022, the Federal Reserve began the most aggressive rate hiking cycle in 40 years, the value of these bonds began to decline steeply. The federal funds rate rose from 0.0 to 8% in February, 2022 to 4.5% in December, 2022, an increase of 4.4 percentage points in less than 10 months. By the end of the first quarter of 2023, Silicon Valley Bank's unrealized losses totaled $7.3 billion. By the second quarter, $11 billion. By the third quarter, $15.9 billion. By the end of 2022, total unrealized losses reached between $15.1 and $17.7 billion, depending on the calculation methodology. Bonds held to maturity, which were recorded on the balance sheet at a nominal value of $91.3 billion, actually had a market value of only $76.2 billion. The true economic hole was $15.1 billion in the held-to-maturity category alone. The bank's total shareholder equity at that time stood at $15.5 billion. Unrealized losses exceeded the entire capital of the bank. If these bonds had to be sold at market prices, the bank would have been technically insolvent. Here, an important question arises. If the bank knew about these losses, why did it continue operating? The answer lies in accounting rules. There are two ways to classify bonds on a bank's balance sheet: available for sale and held to maturity. Available for sale, bonds are valued at fair market value, and any unrealized gains or losses affect bank capital through the line item accumulated other comprehensive income. But held to maturity, bonds are accounted for at amortized cost, essentially at the purchase price. Unrealized losses on these bonds are not reflected on the balance sheet and do not affect regulatory capital ratios. The bank is required to disclose fair value in footnotes to the financial statements, but regulators do not use these figures to assess solvency as long as the bank can claim the intent and ability to hold these bonds to maturity. This is exactly why, during 2021 and 2022, banks massively reclassified bonds from available for sale to held to maturity. The largest American banks added approximately $1.7 trillion to held to maturity portfolios during this period. Silicon Valley Bank increased its held-to-maturity portfolio from $15 billion in 2018 to $98 billion in 2021, a growth of 553%. This strategy works as long as deposits remain stable, and the bank can indeed hold bonds to maturity, receiving fixed coupon payments and nominal value upon maturity. But if deposits begin to flow out and the bank needs cash, it must sell these bonds, realizing the losses and potentially becoming insolvent. And exactly this began to happen at Silicon Valley Bank in 2022 and 2023. When the Federal Reserve raised rates, two things happened simultaneously. First, bond values fell, as we have already calculated. Second, deposits began to flow out of the bank as depositors could find significantly more attractive alternatives. This phenomenon is called maturity mismatch, a fundamental problem of banking. On the asset side, the bank had long-term bonds with fixed low yields. On the liability side, the bank had deposits that could be withdrawn at any time or on demand. When interest rates rose sharply, deposits began to flow from where they earned virtually no interest. The average rate on one-year certificates of deposit at American banks was only 0.3 to 5% in May 2022 and rose to 2.7% by March 2023, significant growth, but still far below alternatives. In contrast, money market funds, which invest in short-term securities with maturities up to 1 year, could immediately offer yields of 4 to 5% as their investments were quickly repriced at the new higher rates. United States Treasury bills with 3 or 6-month terms yielded 4.5 to 5%, fully guaranteed by the government. For a corporation or technology startup with $50 to $100 million in a bank account, moving those funds from earning approximately 0.5% to earning 5% in a money market fund meant an additional $2.2 to $5 to $4.5 million in income annually, too large, a difference to ignore. Beyond economic motivation, there was a risk factor. 94% of Silicon Valley Bank deposits were uninsured, meaning that any depositor with more than $250,000 carried the full risk of bank bankruptcy. For a rational corporate financial director with $10 million at SVB, the question was simple. Why keep uninsured money at a bank paying virtually nothing when you can earn 5% in a fully government-insured instrument? Throughout 2022, SVB deposits began to slowly decline. Clients needed more cash due to economic slowdown in the technology sector, venture financing decreased, and deposits flowed elsewhere to earn higher yields. By March 2023, deposits had fallen to $166 billion from $175.5 billion, at year-end a decline of $9.5 billion in mere months. On March 8, 2023, at 16 hours and 6 minutes Eastern Time, Silicon Valley Bank announced that it had sold $21 billion in available-for-sale bonds, recording an after-tax loss of $1.8 billion. Simultaneously, the bank announced its intention to raise $2.2 to $5 billion in new capital through the sale of stock and convertible bonds. This announcement became the catalyst for panic. The realized loss of $1.8 billion signaled serious problems with asset quality. The urgent need to raise capital indicated financial stress. On the same day, at 16 hours and 30 minutes, another bank, Silvergate Bank, announced its voluntary liquidation, adding to the general atmosphere of fear in the banking sector. Rating agency Moody's downgraded SVB's credit rating. On March 9th, Silicon Valley Bank shares fell 60% during the trading session. Influential venture capitalists, including Peter Thiel's Founders Fund, Union Square Ventures, and Coatue Management, began advising their portfolio companies to immediately withdraw deposits from the bank. This information spread through email, messengers, and social networks at lightning speed. In a single day, March 9th, customers attempted to withdraw $42 billion, nearly 1/4 of all bank deposits. By the end of the day, the bank had a negative cash balance of $958 million and another $100 billion in withdrawal requests to be processed the next day. This was a classic bank run, but with one critical difference: speed. Historically, bank panics unfolded over days or weeks, as depositors needed to physically come to the bank to withdraw cash. In 2023, with online banking and electronic transfers, $42 billion could disappear in mere hours. This was the fastest bank collapse in history. On March 10th in the morning, the California Department of Financial Protection and Innovation closed Silicon Valley Bank, and the Federal Deposit Insurance Corporation became the temporary receiver. By that point, total withdrawal attempts or requests had reached $142 billion, 81% of deposits at the end of 2022. The bank physically could not fulfill these requests. To obtain cash, SVB would have had to sell its held-to-maturity bonds, totaling $91.3 billion at a market price of approximately $76.2 billion, realizing a loss of $15.1 billion and becoming technically bankrupt. On March 12th, the United States government invoked the systemic risk exception and announced that all depositors, including uninsured ones, would be fully protected. The estimated cost to the Deposit Insurance Fund was $20 billion. Later revised to $16.1 billion, these funds will be collected from the entire banking industry through a special assessment. Silicon Valley Bank was not alone. That same week, on March 12th, regulators closed Signature Bank, a bank with assets of $110.4 billion, which had 90% uninsured deposits and significant exposure to the cryptocurrency industry. On Friday, March 10th, following news of SVB, Signature Bank experienced an outflow of over $10 billion in a single day, pure financial contagion. The bank was closed 2 days after SVB. The estimated loss to the Deposit Insurance Fund was $2.4 to $2.5 billion. But the largest collapse was yet to come. First Republic Bank, an elite bank serving wealthy clients and specializing in large mortgages, had assets of $229 billion and approximately 70% uninsured deposits. On March 10th, First Republic experienced an outflow of $25 billion in a single day, 17% of total deposits. On March 16th, a consortium of 11 large banks, including JP Morgan, Chase, Bank of America, and Citigroup, deposited $30 billion as a rescue package. But when First Republic published its first quarter 2023 report on April 24th, it was revealed that deposits had fallen by 41% to $104.5 billion, far below analyst expectations of $137 billion. On May 1st, the bank was closed and sold to JP Morgan Chase. This became the largest bank failure in United States history by asset size, even larger than SVB. The estimated loss to the Deposit Insurance Fund was $15.6 billion. These three banks, Silicon Valley Bank, Signature Bank, and First Republic Bank, became the second, fourth, and third largest bank failures in United States history, respectively. But the problem was much broader. According to the Federal Deposit Insurance Corporation, total unrealized losses across all insured banking institutions in the United States totaled $620 billion at the end of 2022. In the first quarter of 2023, this figure decreased to $515.5 billion, $284 billion in the held-to-maturity category, and $231.6 billion in the available-for-sale category, partly due to interest rate stabilization. But in the second quarter, when rates rose again, unrealized losses increased to $558.4 billion. In the third quarter of 2023, they reached a peak of $683.9 billion, a growth of 22.5% for the quarter. By the fourth quarter, when rates began to decline, losses decreased to $477.6 billion. Researchers from New York University and University of Pennsylvania, who included in their analysis not just bonds but other fixed-rate assets such as mortgages issued at low rates, estimated total duration-related losses across the entire United States banking system at $1.7 trillion as of March 2023. This was nearly equal to the total capital of the banking system at $2.1 trillion. About two-thirds of these losses were attributable to residential mortgage-backed securities, those very same securities considered safest after the 2008 financial crisis, thanks to government guarantees. Where did all this money that flowed out of banks go? The primary destination was money market funds. In 2023, money market funds received a record inflow of $1.2 trillion, the largest annual inflow in history. Approximately 40% of this amount, or around $480 billion, arrived in March 2023 during the banking crisis. Total assets in money market funds grew from approximately $5.2 to $5 trillion at the beginning of 2023 to $6.4 trillion by year end. Over 75% of new flows went into government money market funds, which invest exclusively in Treasury securities and other instruments fully guaranteed by the United States government. Another significant flow was the transfer of deposits from regional and local banks to the largest too-big-to-fail banks. In the week ending March 15, 2023, regional and local banks lost over $100 billion in deposits, while the largest banks, such as JP Chase, Bank of America, and Citibank, received additional deposits as depositors sought perceived safety at systemically important institutions. Some investors began purchasing Treasury bills directly, bypassing both banks and money market funds. The Federal Reserve's reverse repo program, which allows financial institutions to place cash with the central bank at a risk-free rate, peaked at $2.5 to $5 trillion on December 30th, 2022. To understand the magnitude of what happened with interest rates, one needs to look at the figures. In 2021, throughout the entire year, the Federal Reserve's base rate remained at 0.0 to 0.2 to 5% ultra-loose monetary policy following the COVID-19 pandemic. The yield on 10-year United States Treasury bonds fluctuated mostly below 2%, and in August 2020 hit a historic low of 0.5 to 5%. This was an environment where money was virtually free, and investors desperately sought any yield. Banks accumulated bonds, buying everything that yielded at least 1 to 2% annually. But in 2021, inflation began to emerge. In April 2021, consumer inflation in the United States exceeded 2% and continued to rise. By June 2022, inflation hit a peak of 9.1%, the highest level in 41 years. Energy prices skyrocketed following Russia's invasion of Ukraine. Supply chains were disrupted, the labor market was extremely tight, with unemployment at just 3.5%. Fiscal stimulus from the pandemic era created excess demand. The Federal Reserve, which throughout 2021 insisted that inflation was temporary, finally began acting in March 2022. What happened next was the most aggressive rate hiking cycle since the early 1980s. In March 2022, the rate stood at 0.0 to 8%. By December 2022, it had risen to 4.2 to 5 to 4.5%, an increase of 4.4 percentage points in 9 months. The Fed continued raising rates through 2023, and by July 2023, the base rate reached a peak of 5.2 to 5 to 5.5%. This was an increase of more than 5 percentage points in less than 18 months. For context, in previous decades, the Fed typically raised rates by 0.2 to 5% at a time every few months. In 2022, there were increases of 0.5% and even 0.7 to 5% at once, 8 times in succession. The yield on 10-year United States Treasury bonds, which closely follows expectations about central bank policy, rose from approximately 1.5% at the beginning of 2022 to about 4% by year-end 2022, and peaked around 5% in October 2023. This meant that a bond with a 1% coupon, purchased in 2021, was now competing with new bonds with a 5% coupon. Its price had to fall approximately 30 to 40% depending on duration for the new purchaser's yield to match the market. This was the rate environment that broke banks. The European Central Bank went through a similar, though less extreme, path. The ECB deposit rate remained at 0% or even negative for many years. In 2022 and 2023, the ECB also began aggressively raising rates to fight inflation that exceeded 10% in some European countries. By September 2023, the deposit rate reached a peak of 4.00%, the highest level since the 2008 financial crisis. The Bank of England raised its base rate from 0.10% in 2021 to a peak of 5.2 to 5% in August 2023, an increase of 5.1 to 5 percentage points. Even the Bank of Japan, which had maintained negative interest rates since 2016 as part of its fight against decades-long deflation, in March 2024, for the first time in 17 years, raised its rate, ending negative rate policy and setting it at a 0 to 0.10% range. In July 2024, the Bank of Japan raised the rate to 0.2 to 5%, the highest level in 17 years, and in January 2025 to 0.50%. This was a globally synchronized rate hiking cycle, the largest and fastest since the inflationary crisis of the early 1980s. As of October 2025, the current date, the global picture of interest rates has changed. Inflation has declined significantly from the 2022 peaks, though it remains somewhat above the 2% target levels of central banks. In the United States, consumer inflation as of September 2025 stands at 3.0% on an annual basis, a decline from the 9.1% peak, but still 1 percentage point above the Federal Reserve's target. In the European Union, inflation stands at approximately 2.3 to 2.4%, nearly reaching the ECB's 2% target. In the United Kingdom, inflation stands at 2.6%, while in Japan 2.5 to 2.7%, which is actually a positive sign after decades of deflation. In response to this progress in fighting inflation and growing concerns about economic growth, most central banks have begun lowering rates. The United States Federal Reserve conducted its first rate cut in September 2025, reducing the range from 5.2 to 5 to 5.5% to 5.0 to 5.2 to 5%, then again to the current level of 4.0 to 4.2 to 5% in October. The rate is expected to fall to a 3.5 to 3.7 to 5% range by year-end 2025, following additional cuts. The European Central Bank has advanced much further in its rate-cutting cycle, conducting 8 cuts from the peak of 4.00% in May 2024 to the current level of 2.1 to 5% in October. 2025, a decline of 1.8 to 5 percentage points. The ECB expects stabilization around 2% by mid-2025. The Bank of England has reduced its rate from the 5.2 to 5% peak to the current 4.7 to 5% as of December 2024, and is projected to lower it to 3.7 to 5% by year-end 2025. The Bank of Japan remains a unique case, the only large central bank still raising rates, though gradually, as the Japanese economy finally emerges from decades of deflation. The yield on 10-year United States Treasury bonds as of October 24, 2025 stands at approximately 4.00%, having declined from a peak of around 4.6% in May 2025, and recently falling below the 4% threshold for the first time in months. What does all this mean for ordinary people and investors? The first lesson is that even the safest assets carry risks if mismanaged. United States Treasury bonds are indeed among the most reliable investments in the world. From a credit risk perspective, the probability that the United States government will not pay its debt is virtually zero, but this does not mean that a bond's price cannot fall. Interest rate risk, or duration risk, is real and can be enormous for long-term bonds. If you buy a 30-year bond with a duration of around 20 years and interest rates rise by 2%, you can lose approximately 40% of the bond's value over the short term, even though the bond is technically safe and will definitely pay the nominal value in 30 years. For a pension fund or insurance company that can truly hold a bond to maturity, this might be acceptable. For a bank funding long-term bonds with short-term deposits, it is a disaster waiting to happen. The second lesson concerns speed and transparency in the modern financial system. In the past, bank panics unfolded slowly, giving regulators and central banks time to respond. Silicon Valley Bank lost $42 billion in a single day thanks to a combination of online banking, electronic transfers, and social media, which allowed venture capitalists to coordinate a massive deposit outflow virtually instantaneously. On the other hand, information about banks' financial condition is more accessible than ever. Silicon Valley Bank's unrealized losses were publicly disclosed in the footnotes to its financial statements, but few paid attention until it was too late. Investors, analysts, and regulators need to more actively monitor interest rate risk and the duration matching of bank assets and liabilities. The third lesson concerns the limitations of accounting rules. Classifying bonds as held to maturity allowed banks to hide economic losses from the balance sheet and regulatory capital ratios. This created an illusion of stability until actual liquidity needs arose. When Silicon Valley Bank was forced to sell bonds to satisfy deposit outflows, all losses suddenly became real and insurmountable. Since then, regulators have discussed changes that would account for unrealized losses even on held-to-maturity bonds, at least for larger banks, to prevent a repeat of such a crisis. The fourth lesson concerns concentration and diversification. Silicon Valley Bank had an extraordinarily concentrated customer base, primarily technology, startups, and venture funds, all susceptible to the same economic cycles. When the technology sector slowed in 2022 and 2023 due to higher rates and reduced venture financing, many clients simultaneously began spending down deposits. The bank also had 94% uninsured deposits, meaning that practically all depositors were prone to panic at the first sign of trouble. A more diversified deposit base with a larger share of insured deposits would have been far more stable. The fifth lesson concerns sensitivity to interest rate changes for different types of portfolios. Short-term bonds with a duration of 1 to 3 years lose only 1 to 3% of value when rates rise by 1%, while long-term bonds with a duration of 10 or more years can lose 10 to 20% or more. For a conservative investor who believes bonds are safety, it may be surprising that a portfolio of long-term bonds can be more volatile than some diversified stock portfolios over the short term. This does not mean bonds are not safe. They are safe in the sense that they will definitely pay the nominal value upon maturity if there is no default. But if you need to sell before maturity, especially in an environment of rising rates, you can suffer significant losses. Finally, the sixth lesson concerns macroeconomic policy and its consequences. The Federal Reserve and other central banks faced an extraordinarily difficult choice in 2022. Allowing inflation to spiral out of control was unacceptable. 9% inflation destroys purchasing power, especially for the most vulnerable segments of the population. But rapid rate increases had predictable side effects. Falling bond prices, stress in the banking system, economic slowdown, rising unemployment. The Fed chose aggressive rate increases, accepting financial stability risks to fight inflation. The March 2023 banking crisis was a direct consequence of this choice. Government intervention, protecting all deposits, including uninsured ones, and creating the Bank Term Funding Program, which allowed banks to borrow against bonds at nominal value rather than market value, prevented systemic collapse. But it was close. As of the end of 2025, the financial system is far more stable than during the height of the 2023 crisis. Interest rates are falling, which means bond prices are rising, reducing unrealized losses in bank portfolios. Unrealized losses across the system fell from the $684 billion peak to approximately $478 billion by year-end 2023 and continue to decrease as rates decline through 2024 and 2025. Deposits are returning to the banking system from money market funds as the yield difference narrows. Regulators have strengthened requirements for interest rate risk and liquidity management, but the fundamental vulnerability remains. Banks by their nature engage in maturity transformation, taking short-term deposits and making long-term loans or investing in long-term securities. When interest rates change rapidly, especially rising after a prolonged period of low rates, this mismatch creates stress. Understanding duration, interest rate risk, and the dynamics of the banking system is not merely an academic exercise, it is knowledge that can explain why your conservative bank suddenly finds itself on the brink of collapse, why your portfolio of safe bonds lost 15% of value, and why a financial system that seems stable on the surface can have deep structural vulnerabilities, waiting for the next major shock in interest rates. Events in 2022 and 2023 showed that in the modern interconnected financial system, with electronic banking and instantaneous information flows, even the safest seeming institutions can face an existential crisis in mere hours if underlying risks are not understood and managed properly.